Welcome everyone back to FinancialFox Smart Investing with Clem Chambers, our investment guru. But here we have someone else who has made a fortune in stock trading. And I'm really curious to see what you are up to, Robbie Burns, the naked trader.
Well, thank you very much. I'm glad you're curious.
He's also a best-selling author, or pretty much the best-selling investment book in the UK, which is The Naked Trader, which is on like the 147th edition now.
That's right.
Okay. So let's do that maybe. Robbie, do you want to quickly introduce yourself so everybody's on the same page, everybody knows where you made your money and what you're doing, let's do a good intro.
Sure. I think we should also add that Clem is the author of some amazing fiction novels, thriller novels, which are really great, including the first one, The Armageddon Trade, which was my initial favorite. I enjoyed reading that. Should be a movie. I don't know why it isn't. Yeah. Sorry, introduce myself. Yes, I'm Robbie Burns. I've written quite a few books. I don't know how, but and I'm literally just a kind of more long-term investor than a trader, I would say. But I do go short as well as long.
Okay, that's interesting.
I'm glad you think so.
Yeah, we were talking with Clem about shorting, and yeah, Clem, maybe, yeah.
Well, I mean, if I can come in there, see, Robbie is the sort of half trader, half investor, and I'm very much right at the far end of investing, and most people are actually right at the short end of trading, because what Robbie does is he looks for companies that are in a sweet spot in the market, which is not short term and not long term. And that's where all the spread bettors will tell you the people that make the money in the medium term. The 3 months to maybe 9 months is a sweet spot. And that would be fair to say that's kind of where you often look, Robbie. That's
pretty much it, Clem. You've got it.
So spread betting, for some people seems an exciting word, for some other a bit a scary one.
I agree, absolutely. I was talking to someone 3 weeks ago, and she said she couldn't short Superdry because she bought all her leggings and her tracksuit bottoms there, and she'd feel disloyal if she shorted the shares.
That's an interesting point.
She bought the shorts and she doesn't want to short them.
Yes, exactly. It's a strange psychology. People are quite scared of it. And I'm not quite sure why. And some people think that if they do it, they're going to put people out of jobs as well. So there's a bit of, I would say the people I meet, 80% are too scared to do it.
Well, I don't like shorting because I don't do anything that makes me care that I've done it when it comes to investing. So if I short, if I took the smallest possible short on any company, I would constantly be looking at it and wondering whether it went down or not. Whereas I can go any sort of size long and I don't care. And it's better to not really care much about your investments as long as you made them in a good sense. But shorting scares me also. I'm quite good at it, but I feel uneasy. And there's this thing about if you short and go long a company, it goes bust, you lose all your money. If you short a company and it's 10p and it goes to £10, you've lost 100 times your money. And the unlimited downside of shorting is what worries some people and is a little takes the edge off it for me too.
So for maybe traders, they don't know much about shorting. Can we kind of like quickly define what it is and perhaps also maybe what we should do or people should do to protect themselves if they decide to go down to that route?
Okay, well, my thing was always finding companies with massive debt. So, for example, I shorted the AA down from 4 quid to 35p because it owed 2.8 billion and it only made 100 million. So to me, it wasn't really worth very much.
And
so
has no assets.
Barely, Aston Martin's got a debt of billions, and it actually, I don't think it's worth anything, and the Saudis keep putting money into it. But even so, it's still not worth very much. So that's where I get my confidence from. In that, literally, I'm just common sense. I'm going, well, the AA is supposed to be worth 400 million, but it owes 2.8 billion. It doesn't really make any sense. So I will something doesn't make sense to me, I'm just going to go short of it. And that's how I work it. But just think, Stefania, if you're scared, let's say you were shorting something that was £5 a share. Well, all you have to do is stick a stop loss on it, say £5.60 to protect yourself if it goes up. If it goes up, you lose a bit on your short, but not that much. So if you use stop losses, usually the spread betting terms is pretty good and they'll honour your stop. You can even get guaranteed stops with some firms, and the stop's guaranteed even if there was a bid for the company. So there's nothing to be scared about, and it's really quite easy.
Okay.
And also, if you do it enough, and you're, you buy good shares because you like them, and you're pretty sure they're good, and you short companies you don't like because you think they're rubbish, you also get market neutral. So if the market collapses, you make just as much money as you would if the market went through the roof, because they counteract each other. That's what hedge funds do. That's why they're hedged. It doesn't matter which way the market goes. Market neutrality, if you're into that sort of thing, is quite good. I mean, it's really quite a good way to go, because that way you don't have to worry about Jay Powell coming out and saying something stupid, or there being another crazy British Prime Minister or whatever. But again, that's quite sophisticated. I don't enjoy shorting. It's as simple as that. It's too entertaining for me, and I like to do boring stuff, because if you get entertainment value from something, particularly the market, you're being paid in entertainment, not in cash, and I prefer to get paid in cash.
I always like Clem balance point of view.
But Stefania, you're not convinced at all. You kind of said, yeah, but you're still not going to do it. The question I have to ask you is, the market's been going down for 3 or 4 months. Well, even if you have a good company, it's probably gone down. How do you make any money?
Well, I think you raise a good point. There should be criteria to choose company to short, and I think that companies with debt and not much of on the operational side, or on the delivery side, let's call it like that, on the revenue side, then could be good candidates. So identifying that, put some stop loss that you are comfortable with, and decide how much cash you can play with. That probably would be the best. Maybe the best strategy, maybe.
Yeah, I think the main thing is to realize what's the maximum you could lose where you put your stop loss.
Yeah.
How much you're willing, you're willing to lose 100 quid, 200 quid, 500. But there's so many sectors now that are under pressure if you shorted any retail share. I mean, for me, Boohoo, 4 quid to 40p. Okay. There's just so many of them. Jules, that was £1.20, it's now 10p. It's been an open season for being able to short any retailer, and you'd have made your money.
I was going to ask.
There's a lot of good companies too out there that are just going through the floor for no apparent reason.
Okay. I've got one that I wanted to put on the table. iGas.
Sell.
Okay, sell.
I don't anything with gas in it or oil. I'm not interested.
Okay, that's
the reason is I've got no idea how to value these things. I don't know, oil price might go up or down, it's a commodity. I just go, I can't be bothered. I'd rather just pick something I can evaluate. So I haven't got foggiest to find it. However, Clem is completely different to me, which is why it's fun to have both of us on. And I'm sure he can tell you.
I am 97% in cash. I got out a few weeks ago. I literally got out 30 minutes before the Bank of England came in and rescued the whole of the British bond market. So I thought, well, that validates the thought. That could even be the bottom of this particular run. It's just like when a whole country's sovereign debt is on the edge of going down the tubes, it's probably a bad time to be in assets.
I tend to just go on figures. So I just look at market figures. I don't look at any analysts or much about what the news is going on. I don't really care. So I just, whatever the market's doing, it's doing. And I've noticed in the last 6 weeks, it's almost impossible now to find a short, but I'm starting to find value. So looking at the numbers for me, I think there's a big upside. Not quite sure when it's going to be, but looking at the numbers, literally, there's hardly any values left in short. So for example, I found one 6th of October. I just looked at the reports that were coming out in the morning, and I came across Victorian Plumbing, which I hadn't seen before, but I noted that it had a net cash of 43 million, I think it was. And everyone thought this share had come down from 4 quid to 35p. 40p maybe it was. And I bought some straight off because it had a massive net cash of 43 million and very bullish statement. And what it looked like is instead of people selling their houses now, they're doing up their bathrooms. And I think it's about 55p. So I'm up about 25% in a couple of weeks on it. So that was one I bought immediately where I could see the value, very low PE ratio, tons of cash, not going to go bust on you. And that was one where I immediately thought, yep, there's value there. So that was my last major buy.
I've only got 2 stocks, and I had maybe 60 a couple of weeks ago. And one of them is Theresa, which is platinum and platinum group metals, which are totally critical for all this green stuff that's going to be done. And that's in South Africa, and it's ridiculously just off the scale cheap. Apart from the fact it's in a one of those corners of the world which is all these mines tend to be in, which is normally not great news for stability. But anyway, there it is with all this marvelous stuff, and it's small cap, and I'm not getting in and out of that sort of thing. And the only other one which is very interesting to me is Tullet ICAP, which again is just at an incredibly low price, a low valuation.
So Clem's got the brain the size of a planet and can kind of predict stuff, whereas I don't have that facility in my brain. I'm literally going, I don't know what's going to happen next. So I don't actually have an opinion. I'll just follow it. So if the market starts to tank, then I will just take out shorts in the indices. And I usually use ETFs to protect my ISA. So I take out things like the 3 times daily DAX short or the 3 times FTSE short, and that helps to protect the ISA in a downturn. But I think if I was literally looking at the numbers, though, as I said, I'm struggling to find shorts. So I wonder whether a turn is on the way at some point. But obviously, Clem thinks we've got a big downturn to come. But I don't really mind either way. If it goes down, then I'll just follow it down.
But I mean, I think if you're hedging, that is, and that's something you're comfortable with, I think that's a great way to go. I mean, these days, Robbie, we're very different because, I mean, when we last had that Japanese mill, I would be quite happy to play in the small caps, and I find I can't. I mean, for many reasons, and I just can't bear going onto a platform and it telling me they can't quote me. I won't touch those sort of stocks, and if I can bend the price, I don't want to know. So there's so many stocks now. I mean, you must do the same when you move into them. You're bending the price, and I like to be able to say, "Oh, I don't like that anymore." Buy, rather than go, "Oh, I can't get out. I'm going to have to take 4 days to get out of this stock." And so I've got kind of a rule, which is I've got to be able to get out like that. And for that, it needs to be these days pretty big stock.
Yes, you're quite right. There's a very, very lack of liquidity in small cap. I generally play in the FTSE 250, and I find the liquidity on those fine at the minute. You can deal in 20, 25, 30 grand's worth without much trouble. I don't have that many small caps knocking around at the minute. But Clem's quite right. It's a big warning at the minute is if you're trying to buy more than 5 or 6K of anything very small, it's very difficult to get in and out. And they can quote you much worse prices as well, can't they? So it's probably the very small cap sectors to be avoided. Probably talking anything with a market cap of under 500 million or so, probably, or maybe a bit less.
We are already quite some takeaways, which is avoid small caps unless your risk appetite is massive and you are prepared to lose everything and you have got very strong conviction on a small cap. Play FTSE 250, edge your portfolio, and then consider, I mean, I don't want to say consider shorting because it's like encourage people to throw themselves to hell, but maybe learn about shorting. Could that be a good way to say?
Well, yes.
Well, you're either good at it or you're not, you see, and Robbie's good at it, whereas I would look at stocks and go, that's a ridiculous valuation, that's a natural short, and the bloody thing keeps going up, and it not only keeps going up, it keeps going up for years. And I mean, I don't want to name names, I don't want to say Hargreaves Lansdowne. I don't want to name names because, the blooming things keeps going up. And then you got the situation like ASOS, which is 1 minute up in the moon, the next minute down in the toilet. And you go, what happened there? So, I think the overvalued stocks, for me, I see lots of them, but they keep going up. And, unless you've got the touch that Robbie has, which is to actually see the ones that are not going to get, amazing support, then it's very difficult.
One thing I noticed was if you want a stock to go down, is I always have this thing. I realised stocks went bust when their net debt was more than 5 times their pre-tax profits. And pretty much every time I've shorted a stock where the net debt is more than 5 times pre-tax profits, they nearly always ended up going down. I got them massively. I mean, Carpetright was interesting. That stayed at £7 for 1.5 years. I did stick with it. I think it ended up being 5p. Eventually, the market should catch up. But Clem's quite right in that they can carry on going up. But then you just come out, you just exit the short and wait for another entry point. But you have to have the money to be able to have in your spread betting account to protect it, because you don't. I think Stefani is probably worried about you just going to lose money, aren't you?
Yeah, I'm just thinking. What I like is the way that you started, like identify company with debt. Now you're giving a little bit more details what kind of net debt you are looking at, and having maybe those kind of indicators allow you to be more clinical about your decision. Otherwise, you say, "Oh, I've got a feeling this company is going to go down," but then it's just a feeling, maybe based on some macro, some macro parameters, and then it's actually not going to happen.
Pretty much pick anything that was floated in the last year, and it's been a complete disaster, because I reckon they were all floated at crazy prices. And I kept looking at it going, how can you float this at this price? It doesn't make any sense.
Yeah.
Or even how can you float this? Full stop.
Yeah, exactly. So let's maybe talk a little bit about that, because we haven't seen many IPOs on the London Stock Exchange this year.
There's been 6 on AIM this year.
Wow. So I would like, Robbie, maybe you to share your feelings about IPOs, because I'm saying that because there is a lot of fintech, I would say, movement here in the UK, and perhaps many fintech company, they would like to get on the market. So maybe the market is going to come back with IPOs. But what's your feeling, your criteria about listing? And then Clem, if you can share yours as well, that would be great. So we can kind of cover that segment.
Well, mine is very simple, is that what's the company valued at coming on the market, what's its net debt, and what's its likely profit next year. And when I keep seeing companies that are valued at $1 billion, they might make 10 million and they've got a debt of 200 million, I'm going, this is literally will take me 30 seconds to look at that and go, this is crazy. I don't go any further into the financials because it looks crazy than it probably is. And they were all, I mean, I was doing about 9 months ago, a year ago, I was doing a Naked Money podcast with a millennial who wants to learn the markets, and he would come up with a share and I'd come up with a share, and his share was always some crazy American tech company that was valued at, I was going, it can't be valued at 77 million. It doesn't make anything and it's got debt and I don't understand it. No, don't buy it. But it was just crazy. I think we've just been through a crazy period where valuations have been nuts. Yeah. And it's almost good the market's come down to where you can start to value companies at a level again where it makes sense to buy them.
I think that's totally right. You see, I see it from a different perspective. I see that the way that economies are managed these days by printing money and managing liquidity pushes that money into low liquidity assets, which then props up the whole system. But because of that, you get these shoals of Klingons that pretend that basically feeding on this flow of money that are worthless, and you get this effect that the rising tide raises all ships, and you get all sorts of fun and games going on around assets and money flows, and the sort of things that investment banks do, and you get a decadent, degenerate market, and you're seeing one of them now. I mean, another way of looking at it is this: Berkshire Hathaway, Warren Buffett and Mr. Munger, their company has a 50 PE. Buffett wouldn't touch a company with a 50 PE with a 10-foot barge pole, and yet his company's now got a 50 PE, which really, in a nutshell, sums up the problem with the market in America. And when that comes unglued, which is happening right now, that's going to pull everything else down.
And it's your chance to go short, Stefania, when you get rid of your fear.
Yeah, exactly. I think I'm going to look into that. And first of all, I'm going to have strong conviction. And then, yeah.
There's a trick. If you're going to do it so small that you don't care. And then if you win, just increase the size a little bit, and then just increase the size a little bit. And
there's always the naked trader guide to spread betting edition 2.
Exactly.
It takes you through loads of examples. I'm not even plugging it because I only get quid a copy. As Clem knows, you don't make any money writing books.
I mean, you do, because you sell lots of yours. I've got to tell everybody that Robbie's books are brilliant, and they're not number one for nothing. They are. If you buy 50 books on investing, very few of them will be any good. Most of them will be getting you in trouble. But Robbie's books are exactly what you want to do. If you ever want to get into investing, trading with a small t, his stuff is the best out there. I would utterly, totally recommend them. And I do.
Okay, guys, thank you so much. And I will see you at the next one.
No, we refuse to go. Try and stop it. We don't want to talk some more. You've been trying to get rid of this.
She has the button. She has the button, I'll tell you.
She's gonna, yeah. Invite us to a party at your kitchen soon.
Yeah, definitely. But we get you into crypto first.
Great. All right, we'll go then.
Bye, everyone.
Bye, everybody.